Hi and welcome to another episode of Monday Market Outlook. It was a tale of two markets last week as we saw the PSEI succumb to some pressure selling due to the MSCI rebalancing, while the S&P 500 reached new highs. We started out the week with the BSP coming out with their inflation outlook estimate of 5.8 to 6.6%. So this is good news as a 5.8% inflation rate in May would mean that we've had 4 months of inflation steeply going down, and it will be the lowest inflation rate in 12 months. If you look at how inflation peaked in January, it has dramatically gone down ever since. With a dramatic slowdown in inflation, the BSP could continue to pause rates or even start cutting rates from 6.25 to 6%. Now, this would be good news for some of our real estate stocks if that happens. Now, another news came out that Philippine debt rose further to 13.9 trillion. And if we look more closely, around 68% of that represents domestic debt and only 32% represents external debt. Part of the reason for that increase is also the strengthening of the dollar or the weakening of the peso, which of course affected our external debt, where a large part of our external debt is in US dollars. And in terms of our debt to GDP ratio, it stands at around 61%, which is just a bit above 60%, which is the ideal rate. Now remember that the debt to GDP ratio means that the amount you owe should be commensurate or should be only at a certain percent of your income earning capacity. In this case, 60% is the ideal number, and we are currently at 61%. So we are quite healthy. Crude oil is also experiencing a sell-off, with the Saudi minister already warning speculators to watch out. Let's see what that means in the coming weeks. But currently in the PSEI, looking at some charts, we mentioned that the ideal scenario would be for the PSEI to bounce off of this support level. However, it succumbed to further MSCI rebalancing, breaking our trend line support level here. So I guess we can delete that because this trend channel no longer holds. But if we look at the weekly chart, this is still a higher low compared to this, and that rejection week means that buyers again are still ready to come in at these levels, right, at 6,420. So for this week, have we seen the last of the irrational selling from the MSCI rebalancing? After Friday's rally, could we see the bulls push the PSEI up to its 6,650 resistance? And let's see how the market reacts at that level. Now, let's look at some individual stocks here. BDO coming off of the support level, 132. See? Metrobank also coming off of the support, 5640. Now, this is an interesting chart here, BPI. If we look at the long-term chart here, this has formed a higher low and a higher high consistently. Now, could this be a good opportunity for a swing trade, right? So how can you do a swing trade here? You see, every time it hits 102, it finds some sell demand, so you can enter into 102.2 or 102.3. Set a stop loss here. You can set a stop loss here and a take profit here, right? So you can swing trade this. This is a 4%, and if we find ourselves here, almost 12%. So that's 1:3 risk reward ratio. So we could be looking at a potential swing trade for BPI in the coming weeks. Semirara also retracing. DMC finding a bottom here. Could this be a double bottom, and could we see DMC rallying in the coming weeks? URC also retracing to a convergence of support here. You can see a long-term trend line support converging with this support line. Could URC find support next week? And this could be a good opportunity for buyers to come in. DNL, bad news for DNL, of course, as we mentioned, if it breaks the 61.8 fib here, the next support is 7, given bad outlook for DNL. Any rally from DNL will most likely be met with sell demand. No? SM and AC actually going nowhere. JFC also in the middle of things. Apex, a good opportunity to enter as mentioned. Could Apex hold its level there given that gold went significantly down last Friday? So if we plot in gold, right? So we can see gold going down last Friday. Could we see Apex retrace at the beginning of the week, right? But this is still a good level. This was a good level for investors to enter. Now, Bloomberry also bouncing off of its support level at 10, right? So Bloomberry was a candidate to enter the index given the potential delisting of MPI. But now that the delisting talks of MPI has been halted and reevaluated, of course, we saw a retrace on Bloomberry, and given its promising outlook, this was a good opportunity to buy into Bloomberry. As mentioned, an interest rate pause or even a cut could mean good things for real estate stocks. So let's look at Ali. It's currently at its support level at 26, no, 25.95. Could Ayala Land find support at this level and rally in the coming weeks? SMPH, maybe some ways to go, could be hitting 31.65. But if we look at SMPH and talking about our buy low, sell high strategy, are we buying low at this point, right? Yes, we are. And this is actually already quite an attractive level for investors to consider SMPH, especially for the long term, given that the risk potential is low compared to the upside potential. See? So on to the global markets. Of course, as expected, the debt ceiling was passed in Congress and eventually in the Senate with a 63-36 vote, ensuring that the US can pay off its debts. No? But again, more economic numbers coming in to give us a better idea on what the Fed will do when it meets next week and decide whether it wants us to pause rates or increase rates by 25 basis points. Now let's look at the results here. Chicago PMI numbers going down significantly, continuing jobless claims not as high as it should, showing some resilience in the labor market. Initial jobless claims also not as high as expected. PMI numbers also down. Average hourly earnings a bit steady here, but non-farm payrolls here, we're expecting 180 jobs generated, but instead we got 339,000 jobs. The unemployment rate though increased from 3.5% to 3.7%. So we're getting some mixed numbers, and we are still showing a very strong labor market in the US. Now, given the economic numbers that came out last week, look at how the expectation has shifted. We were looking at a 53% chance of rate hike last week, and now it's down to 25% with a 74% chance that the Fed will already pause interest rates when they meet in a couple of weeks. Now, if we look at the S&P 500, the market reacted wildly with the resolution of the debt ceiling as well as the expectation for a Fed pause. And as you can see, this was our expectation. We were expecting the market to hit new highs, 4,281. It hit right smack in our critical zone. And if you see the weekly charts, let's compare that with this weekly chart, right? So the last time the S&P 500 hit this critical zone, right? In the next week, it did a fake out before a massive sell-off. Now, the question is, are we going to see the same behavior from the markets? So, as we mentioned, expect the market to trap investors by rallying up to 4,300 and then the eventual sell-off. From what we've seen, it's not far off that this could happen. That's why we've always said to be careful. Let's see some other indicators. Here's the triple Q versus the SPY. We're seeing a strong resistance here. I think that the market may have run out of hype and could lose steam in the next coming weeks. If we look at the triple Qs versus the Russell, the last time this big rally happened, we've seen a period of consolidation before a sell-off, right? Now let's look at the semiconductors where most of the AI hype was happening. See, are we losing some steam in the AI hype? Now, if we look at consumer discretionary versus consumer staples, could we see a reversal in the next few weeks? Let's look at the three defensive sectors. We have consumer staples, healthcare, and utilities. You see consumer staples, no indication yet of a reversal. Healthcare has already bounced off of that support level. Utilities also, no indication yet of a rotation. But if you look at the sector rotation last Friday, you see industrials, utilities, electric, basic, consumer staples outperforming the SPX. So the massive rally last Friday was no longer about AI, but more a rotation on the defensives. Could we see the same movement in the coming weeks? Usually, every time we rotate to the defensives, that means that the market is not far from a sell-off. So that's it for this week. I hope you found this episode useful. Please like this video, subscribe to the channel, and as usual, good luck on your trades. Please manage your risk accordingly, and I'll see you again next week. Bye-bye.